everybody. I'm Michael Mandel, and this is CompStak's Not Podcast podcast. With me, I've got Steve Kuritz from KBRA. I'll let Steve introduce himself, and we're going to talk today about CMBS surveillance, KLOCs, and you'll see we'll talk about what that is, the upcoming office maturities and defaults, and how CompStak data is also leveraged by KBRA in understanding all these things. So let's jump into it. And Steve, why don't you tell us all who you are?
Sounds great. Thanks for having me, Michael. I'm Steve Kuritz. I spent close to 30 years in CMBS across surveillance products, ratings, research, and investor reporting. I've been at KBRA for about 13 years now, and my main focus is on KBRA credit profile, or KCP. And KCP sits within KBRA Analytics, which is completely separate from our ratings business. And what we do is loan by loan credit surveillance for the CMBS market.
All right. Well, let's jump into it a bit. 46% of loans that matured last month defaulted. Is that right? And 84% of those were office.
84% of office loans that matured last month did not pay off.
So that's pretty staggering, right? That doesn't seem like just a stat, a structural shift perhaps in the market. What does that mean? Are we in a credit crisis, or is this just a repricing cycle?
It's kind of a repricing cycle, and not all office markets are created equal. You have some really good elite markets like New York City, your premier Class A, well amenitized properties are performing very well. But in the same market, you can go a couple blocks in either direction and see Class B, Class C properties not doing so well. And then you have other markets like Chicago, Denver, with their own stories that we can get into a little bit later or whatever.
Let's dig into that. Obviously, if I'm a building owner in Chicago, I'm thinking about my building. I'm thinking about the debt on my building. I'm probably not dreaming about CMBS, although maybe if my loan is securitized, I am. But you guys are thinking about it every day, and you're looking at these loans every day. What do you see? What do you see in the market that maybe your typical, office building owner is not seeing?
Well, we're going to talk about Chicago. Chicago remains one of the most stressed office markets in the country. Vacancies elevated. I think it's running around 27% right now, and values have deteriorated significantly. So in our data, roughly 77% of Chicago office loans by balance are classified as KLOCs. And those are KBRA loans of concern. And our weighted average leverage, is north of 170%. But what's interesting about that market is that Chicago's no longer in denial. There's active initiatives like LaSalle Street Reimagined, and real TIF dollars being deployed, and pricing is resetting meaningfully. So in that market, say a good example might be 175 West Jackson, originally appraised at $347 million, now valued closer to $80 to $120 million. Occupancy has fallen from over 90% at origination in CMBS, and now occupancy is in the low 50s. It's facing continued tenant rollover. So that's more of a repricing story. Chicago is clearly under pressure, but it's also one of the markets that's most actively confronting reality, I guess you could say. And just to kind of preface it, KCP and CompStak, we're going to put a joint piece on Chicago. So I don't want to get too into Chicago, but I think that's almost done, and that's going to be a really good in-depth piece.
Yeah. So when you guys are identifying the risk of default, you have this concept called KLOC.
Yes.
Can you tell us what is a KLOC, and how do I install one on my door?
Yeah, right.
That was a really lame dad joke right there.
When we came over to KBRA in 2013, everything was KBRA something. So it's K something. So KLOC is KBRA loan of concern. So it's simply a loan that's flashing warning signs. And they include loans that have already defaulted, as well as loans that we feel have a higher likelihood of default over the near or intermediate term. So for KLOCs, we're looking at cash flow, debt service coverage ratio, occupancies, bankruptcies, maturity risk, tenancy issues, the whole gamut there. So that's a KLOC. And
how does that differ from the watch list that everybody's heard about?
Yeah, so the servicer watch list, it's just part of just standard procedures. The servicer watch list is kind of regimented. They have certain triggers. If a debt service coverage ratio is below X for multifamily property or whatever. But, some of the watch list criteria aren't something that we would look at from a credit perspective or be too concerned about from a credit perspective. Example of that would be items of deferred maintenance, right? Like you could have a $300 million multifamily complex and an inspector went out and noticed 2 pieces of sidewalk are cracked. So it's deferred maintenance. It's not going to tank the property, or the parking lot needs to be restriped or something like that. Or a tax payment escrow was short $100 and it's like a $10 million payment. It's not really a material issue. So that's what distinguishes KLOC from servicer watch list. KLOC is really what we feel are loans that have defaulted, or loans that we feel have a high likelihood of defaulting over the near to intermediate term.
Got it. So the watch list has a lot of noise in it, and has the industry gotten to a point where people are just like, oh, forget it, I'm not paying attention to the watch list? Or do you find that people are just really focusing in on the KLOC instead of the watch list at this point?
Well, I would say for subscribers to KCP, that's all they care about is a KLOC, right? I mean, delinquency rates for conduits are roughly 8.7%, I want to say. Versus watch list from a percentage perspective is something like 12% and change. Whereas KCP's KLOC, we have a KLOC index, so that's for the whole market. That is 27%, and it's approaching our all-time high of 29% set in 2021, which was right post-COVID. And then just to kind of highlight office properties, 43% of office properties in CMBS carry a KLOC designation.
Wow. Wait, so let's double down on this a bit. So you're saying you're at the highest KLOC percentage since COVID at this point. Like you're seeing.
Yeah, it's just about as high, like for total K, like our all-time high for the KLOC index, which is the bellwether for CMBS performance, was at 29% just post-COVID. And that started to come down over the several years post-COVID, and now starting to tick back up. And it's primarily driven by office properties. If you dissect it a little bit, so our KLOC index right now is 27%. The office, so if now you separate it by property type, the office KLOC index, so just for that property type, is about 43%. Whereas for other property types, lodging, 27%. So it's kind of in line with the KLOC index. So that's kind of normal. Retail, 24% below the index. And multifamily KLOC index is 14%. So really it's the office properties that are sticking out right now.
And I got to imagine that when the overall index was quite high during COVID, it was probably different asset classes at that point, right?
Absolutely. You're spot on. During COVID, hotels are a nightly business, right? So no one was traveling. So we were like, oh my God, is every hotel a KLOC? But they came back really, really quick. Hotels did. I mean, first you started to see like you needed to have infrastructure, right? So all the hotels that supported commerce the interstate hotels so truckers could stay overnight. They kind of bounced back quickly. Then, the resorts that are in, leisure travel actually, took a long time to come back, but you had really good properties. So it was really just a matter, and a lot of those properties have business interruption insurance
Yeah.
where it wasn't, a big deal. And as soon as people could get out away, from their house, lodging just went gangbusters, And then retail was hit hard, right? Obviously. So the KLOCs were dominated by lodging and retail. Retail was hit really hard. I mean, during COVID, the only places people were going were grocery stores and pharmacies, right? They weren't going to the malls. So during that time, a lot of retail properties defaulted and really had to right size. And that occurred over the last few years. So both retail and lodging have pretty much stabilized. There's still issues, right? I mean, retail is its own kind of animal. There's always retail. What we follow with retail are a lot of the retailer defaults. So what's most recent? Eddie Bauer, Saks, GameStop shutting locations, Francesca's. So that's something that we always monitor as part of the KCP service. And just, our users can get a quick view of what their exposure is to those retailers. But yeah, so now it's dominated by office. So, so office is dealing with a combination of structural demand shifts and financial timing. So, the long-term leases and that nature of office delayed the impact of hybrid work. And now that rollover is happening. So the lease roll in conjunction with maturities, and you're in a higher interest rate environment. So it's kind of a perfect storm for offices right now.
Yeah.
So,
Well, I think it's really telling, right? The lease impact is huge, right? And to your point, hotels don't have
for sure.
hotel leases are one night at a time, so they immediately got impacted. Retail, there's longer term retail leases, but I think the difference between retail and office is that the retailers, their business is their space,
Right.
whereas for office, your business, your office space is an expense of your business. And so the retailers, they just went out of business, right? They may have had long-term commitments, but they were going bankrupt and they were shutting down locations where it didn't matter if they were in a long-term lease or not. They shut it down. So retail got hit harder. Office, it's this protracted cycle of companies that were hit 5-6 years ago, right? Where the businesses have done, the companies themselves have done decently well, right? The stock market's up. Businesses generally are doing fine. So they didn't have to default on their leases.
Exactly.
Right? But now those leases are coming due because your typical office lease is 5 to 10 years, some longer, some shorter. And so we're just seeing this wave of lease expirations and some are not renewing, right?
Right. A lot of properties are giving back space, or a lot of tenants are giving back space. KBRA's got a mix of both, right? So I'm in our Pennsylvania office, and we might actually downsize some of this space here because of remote work. But in New York, we're expanding, and we're moving from Class B, Class C space into Class A space. In fact, CompStak was one of the first places that reported that lease. So even before they made an announcement to the employees, it was reported on CompStak. I'm like, hey guys, this just popped up.
That's pretty funny.
Yeah.
Although we love it when that happens. Maybe your management didn't love it. But it's not atypical for us. So one thing we've really seen in office throughout this time, right? I mean, the defaults have been rolling. The stress in these assets has just been increasing and increasing over time as the vacancy goes up, and you're seeing and obviously the interest rate environment is a huge factor because
It is.
you tell me what's the average length of a loan on a commercial office building?
Well, traditionally it's 10 years, but there's been it's kind of merged more towards 5 years.
So depending on when these when these, loans rolled.
Yeah.
People have just been, it's a double whammy, right? You've
Oh,
got
it
you've got
certainly is.
the vacancy increasing, your interest rates are going up. So even if you had enough buffer built in from a DSCR perspective that you could refinance with lower vacancy and be fine, well, now you can't refinance with lower vacancy and be fine because the interest rate is so much higher. And so we've
Yep.
seen a lot of, extend and pretend. Or is it pretend
Yes.
and extend? I never know the order. Either way, you're
There's
extending
a
and
lot. There's a
pretending.
lot of that, right?
So
Yes, for
is that
sure.
still happening? Is it a real reckoning now, or is it
It
more
is.
extend and pretend?
So I think it. I mean, it does. It is very asset specific, market specific, and submarket specific. As I mentioned, 38 billion across 2,200 loans are scheduled to mature over the next 12 months. I think I mentioned it. But a third of those are secured by office properties, and so far, 2026 is not looking great for office maturities. And we talked about the 84% of office loans that matured last month defaulted. So it doesn't mean that they're all poor performers. It's just taking a little bit longer to arrange for financing or infuse more equity in the property. So, what happens when a CMBS loan defaults at maturity? Then and pretend is one of them, right? So if you have a decent performing property, but maybe there was some tenant roll and that had an impact on getting financing, a borrower is going to seek an extension to try and stabilize the property a little bit before they're able to refi. Equity injection. I mean, we're seeing a lot of that, especially in New York. That's where a borrower contributes capital, and maybe they're bringing in a partner to right size the loan, and that stuff is happening in good markets, bad markets, or an asset sale. They get to maturity and like, there's no way we're going to be able to. We feel like there's a little bit of equity in it for us, so we're going to try and sell it, give us a little bit of an extension while we sell it, or just foreclosure. Or the trustee, the special servicer will look, maybe do a note sale. And there's also a lot of repositioning or conversions for select assets. And we see those and see that happening in a lot of different markets. You see it happening in New York City, you see it happening in Denver. So there's a lot of a bunch of different decision paths that a property can take.
So, you mentioned a variation across markets. Could we talk a little bit about that? I think Chicago is at a 77% KLOC for office. Denver is 53%, for I saw from your notes. Seattle, you've got the CBD versus Bellevue situation going
Yeah,
on.
sure.
How's that playing out?
Yeah, so we talked about Chicago a little bit. We talked about New York a little bit. Well, let's do Denver. So New York City is more of a bifurcation, right? Chicago has stress plus policy engagement with LaSalle Street Reimagined. Denver is like capitulation and extreme repricing. So it's the most stressed major office market in our coverage. Its KLOC index, as you mentioned, is over 50%, the highest of the top 20 MSAs that we cover. And what makes Denver notable isn't just the stress; it's like the scale of repricing. We're seeing single-digit valuations per square foot in parts of the CBD. So, like, for example, former World Trade Center towers right downtown, and CMBS originally appraised for 176 million, ultimately sold for 5 million. So $6 a square foot, but that's with plans for conversion. And then even larger, better known assets like Republic Plaza have also defaulted and seen material value declines. But what's interesting there, I mean, so Denver represents a market that has moved beyond denial and is into full price discovery. So the reset there has been dramatic.
What is it about Denver? Why is Denver so much worse than these other
Um,
markets?
I think it's a combination of elevated new supply from the prior cycle, significant tenant downsizing, and capital structures that were built for a different demand environment. So when leverage is high and occupancy falls quickly, there's very little cushion. I think you saw a lot of outward migration of oil and gas companies in Denver. I was reading something, I believe it's back in 2015, oil and gas tenants in Denver CBD office represented something like 35 or 37%. Now it's down to single digits. Some of that was downsizing, as all office tenants did, but a lot of oil and gas tenants migrated out to the suburbs. Just a little bit of outward migration. But what we're seeing, the Lozado company, I think they're based out of California. So they acquired World Trade Center, World Trade 1 and 2. That was the $6 a square foot. They also acquired Colorado Towers for $3.2 million or $3 a square foot. And combined, they're looking into a massive conversion. I think it's over 1,000 residential units, and they're going to keep a little bit of the office. So I think it's a net positive for the market, right? It's oversupplied, so it takes some of the office offline and also brings in more demand, right? With your residential conversions. So, I mean, it's going to take a while for Denver to be downtown Denver to be, something. It won't be what it once was. It'll be something different and maybe better. But yeah, it's definitely going through a major repricing.
Interesting.
Yeah, it's an
And,
interesting market. Um,
and then there's also, this interesting paradox of what's happening between Seattle CBD and Bellevue.
you know, Generally what's happened there, Bellevue, suburbs, they have newer buildings, strong tech tenant base, and a bit more favorable business environment. The Seattle CBD, it's like older inventory, higher expenses, and I think more friction around repositioning from what I'm hearing. Those differences matter a lot right now. I mean, it's important for the cities and municipalities to get involved because ultimately impacts their tax dollars, right? So, um, so Chicago, you see, a good collaboration, um, and maybe Denver's working that way with, allowing for repositioning. But yes, I think Seattle's probably, the next shoe to drop when it comes to office markets.
Thing. So I'm interested in, obviously, we mentioned the fact that you guys leverage CompStak data internally, and specifically our leasing data. I think primarily, I think you probably have access to the sales transaction data as well. I'm curious, and have you seen examples where you had a view on a particular loan, a particular asset, and uncovered, data from CompStak or just generally leasing data that changed your perception of that asset and impacted the way that you scored it?
Yeah, I would say, that happens frequently. Historically, credit data and leasing data lived in separate worlds. Kind of KCP and CMBS tells you where risk is emerging, and then CompStak helps explain the why, right? So together, it's a much more complete and forward view of an asset's health, I would say. And just generally, I mean, CMBS data, it's good. I mean, CMBS is very transparent in reporting, but you don't get a ton on tenants. You get information on the top 5 tenants in a property. When their lease is expiring, what percent of the property they are, but it doesn't necessarily give you the rents, right? You can go back to like maybe 5 years ago at issuance, they did report that for the 10 largest tenants or the top 10 loans in a particular condo deal, but it's generally not available, right? So now you're looking to market players, so our analysts will call brokers and shop properties and stuff like that. But CompStak is great for bringing in that transparency. So I guess if we're going to talk about an example, I guess 200 West 57th is a good one. Class B office tower, Central Park South. We were already monitoring it as a KLOC, giving it some credit because it was a very granular tenant base, right? So, not very lumpy, so not a ton, not huge risk. But then you guys reported a lease renewal for St. Luke's, which is 13% of the building at $62 a square foot, which was below historical rents, I think, of 75 square foot. That led us to kind of adjust our discounted cash flow model a little bit to hit a little bit harder. That property, that loan also has a 3.25% interest rate, right? So good luck refinancing. So yeah, it's little things like that. So, I mean, ultimately what drives property value is the revenue that comes in from its tenants, right? So when you have a clear view in general, so CMBS data, yeah, it's reported monthly, but you get financial information on a quarterly basis. So we're mid-February, and we're still probably waiting. CMBS participants are waiting for year-end financials to come out, right? So it's very back. So it is transparent, but it's also backward looking. So what we try to do at KCP is take that backward looking information and move it forward. So, and CompStak is a great partner and one of the tools that we use to help to form a forward looking view of properties and valuations.
We're seeing a lot of defaults and maturities. Meanwhile, CMBS issuance is strong, right? What's going on there?
It's an interesting time in the market. Like it's the first time we're really seeing this. Usually when there's a high amount of defaults, new issue is kind of slow. 2025 was a record year. It was the best year for CMBS issuance since the GFC. So that was an interesting year, and 2026 is looking strong as well. I think it's just there's capital out there to be deployed. It means to me that yes, there's risk, but it's at isolated, measured risk. The deal structures have changed a bit. Back in the day, conduits used to dominate, new issuance. So conduits are a pool of loans, like maybe 50 or 100 loans versus SASB, single asset, single borrower, which is typically just, one property, one loan, but it can be a portfolio. So now you're seeing more SASBs issued than conduits. So that's interesting, but it's easier to monitor, right? Because you just have the single property risk. So yeah, SASB and series CLOs, which KCP also covers, it's a different kind of animal. They're transitional properties, but we do cover that subsector as well. So yeah, it's an interesting time for sure. There's definitely going to be, a lot of defaults coming down the pike. You have this whole maturity wall thing with office, the office dynamics right now. It's an interesting time to be in surveillance of commercial real estate. So,
Sure.
I mean, as an old guy, I like, it's an interesting time for me for sure. And it's, it's not like it's manageable now versus like say the GFC. You had a valuation bubble and valuations dropped 40% overnight. And CMBS are generally non-recourse loans, right? So borrowers were immediately underwater and they're like, all right, yeah, we're just going to hand over the keys to the property. So we had massive amounts of defaults back then, and it was just super hard to manage that process back then. This is a little bit more manageable. Plus, we carry a staff of 40 analysts covering 1,400 CMBS transactions, 900 plus billion, 30,000 loans, about 50,000 properties. It's a lot, but we have a very big staff doing it.
I'm curious, you said this is the largest amount of issuance since the GFC. What's the differential though? Because that was just, crazy at that point, right?
I think it topped off. I'm in a different office, so I don't have the information right in front of me. I want to say it was 240 billion versus 135 billion.
Okay, so still a huge differential.
Yeah, so yes.
From 2007, let's say.
Yeah, back then, I remember 2005 to 2007, as a younger analyst, like every 2 years, I'm like, well, this loan has appeared again. It defeased out of that deal, and now, the debt is doubled. Okay, that makes sense. but yeah, so yeah, much different times.
Are there certain markets, by the way, we were talking about, I'm sorry, I'm going back and forth, but
That's
we were
okay.
talking about different markets and different places. Are there some markets where you feel like, you know, people are maybe wearing rose-colored glasses and they're not recovering as much as they might appear, and other ones that maybe are underestimated in your mind based off of looking at, what's defaulting right now?
I think New York is really interesting, right? It's got some of the best real estate in the world, and that shows. Like we're saying, Midtown Class A, well amenitized buildings are doing awesome. But from what I recall in my career, we're seeing a lot more defaults of New York City office. So you really had to be discerning when you're looking at credit in New York City. I mean, we had God, what was it? 1740 Broadway. So that was like the L Brands property, and it was a 2015 CMBS deal. 300 million $300 million loan. Took a $190 million loss. And that was a SASB deal, so single asset deal. So that one ate into the AAA rated classes. That was the first to happen in this cycle. So you definitely need to know your credit right now. I mean, that was a lot of exposure to L Brands, of course, but yeah. And then you had a lot of offices that were formerly leased to co-working spaces like WeWork
Sure.
and Notel. Some of those are looking to be, repositioned, conversions from office to resi. So, and then I'm sorry, I'm just kind of going off a tangent here. Some better markets. I mean, it's not all bad, right? Like, I think markets like in Texas, Austin, Houston, Dallas, like they're growing, right? You have a lot of companies moving out of California to go to Texas. Normally, and I think during COVID, you had a lot of companies experience some of the Florida weather and get it. So Miami is just, I mean, you go to Miami, we're just there for FFC in January, which is one of our annual conferences. And there are just cranes everywhere, building office, building resi. It's booming. I mean, and Texas has its own stock market now, right? It's, businesses are migrating, and they're migrating to cities, that are more favorable from an expense perspective and quality of life too. So there are good markets out there. In our world, we just kind of tend to look towards, what's defaulting, what can we value it at, because, our valuations directly impact, our clients are investment banks, hedge funds, money managers, and they're pricing CMBS. In fact, everyone tells us that the CMBS secondary market trades off of KCP's conservative values. So that's quite an honor. It's a good reputation
Yeah.
for us.
Well, it's interesting, we're talking about all these office, defaults, but when we talk to our clients today and our prospective clients, we're hearing, the strongest interest in investing in office that we have since COVID, right? Because, it may not be totally obvious, but when the defaults finally start happening, that's where the opportunity lies, for
Absolutely.
buyers. And the pretend and extend um, made it difficult, because the prices were staying high, and anybody who wanted to come in wasn't going to pay those prices, and so everybody was sitting on the sidelines, and now deals can finally happen. So that creates exciting opportunity.
Yeah, absolutely. Well, you can go to Denver and pick up office for a couple of dollars a square foot. But yeah, New York is, I think it definitely creates more there's opportunity. Distress in general causes opportunity. And, when properties have the right size, that's where opportunity is, right? So you'll see a lot of properties trade hands. You'll see a lot of equity infusions, partnerships. So it is a good time to to invest. But at the end of the day, you're taking out debt on a property, and it has to be right sized to today's valuations.
Yeah, absolutely. And personally, like I think Denver is a great city. And I'd probably invest in Denver sooner than some other places, but I'd probably sooner invest in San Francisco,
Right.
or New York, in a market that's bigger, a little more established. Um, I think that there's a real upside. I mean, to your point about the oil and gas industry, these, um, it's interesting when most of the time when a market really gets slammed, it's due to some sort of crisis in a particular industry. Now, we've seen a lot of distress across the board here, but to your point, Denver's hit harder, maybe because of oil and gas. And the nice thing is when you come out of that cycle, um, often you'll see more diversification amongst the tenant base within that market as the market recovers, making that market more stable, right?
Completely agree.
Um,
Yeah.
and, certainly with the GFC, New York got hit because of, so many financial firms. But as the market came back, like New York is much more diverse by way of tenant base than it was in 2009, you know?
Yeah. The elite
And
markets bounced back after the GFC very quickly. New York was amazing bounce back. New York, DC, San Fran was doing well at the time. They all bounced back really quickly. Yeah, nowadays it's a little different story. But yeah, as you said, some of these markets reset, reprice, and diversify with tenants. It makes it better for everyone involved.
I think that that's probably, I don't know that too many people do it, but I feel like if I'm, going to be a long-term investor, well, first of all, if you're going to be a long-term investor, you're going to do well in most places. I think, it's
Right.
the problem is the people who aren't long-term thinkers. But if I'm going to be a long-term investor, I think an interesting analysis to do is to look at the tenant mix in a given market, and any market that has grown too much off the back of one particular industry, that's, you never know when that industry is going to implode, and you don't
Yeah,
want to be there to, to be the victim of it.
you're right. And that's something that CompStak is also very good at, you can look at industry risk too, within a building, within a micro market, right? And you might flag those as a little bit more risky.
Yeah. And we now do it, not to put in a plug, but we now do it for portfolios. So we have our portfolios tool where you can layer in a portfolio of any buildings, and we'll show you the tenant makeup by way of particular tenants and what percentage of that portfolio they have, as well as the industries in that portfolio.
Oh, that's great.
So theoretically, like you could plug in all the properties in a particular bond, and you could plug that in and build a portfolio from that and see the underlying tenancy risk from that perspective as well.
That's a
Uh,
great concept.
you know,
We employ a similar concept to retailers in KCP. We set up these exposure groups, right? So if you're holding, whatever, GameStop is closing X number of stores, you can just go right into KCP, click on what's my exposure to GameStop, and if you have a portfolio set up, it'll give you your total exposure, which is great. So that's an awesome tool.
so it seems like we're well aligned in the thinking there, and obviously in retail, it's an even stronger
Right.
risk, no doubt, because these retailers, I mean,
It's always something.
can swing one way or another in a huge way. So let's try to close it up here, because we are short on time and probably short on attention spans. Although I think they say the people pay attention to things for like 30 seconds, so we're long past due on that.
Yeah, for
Um,
sure.
but if you had to pick one indicator to watch over the next 12 months, what would it be?
Well, I mean, I think it has to be maturity, right? I mean, that's just, with so much maturing in CMBS over the next 12 months, that's where our focus is going to be. I mean, our main focus, right? But in addition to that, we're always monitoring the performing properties that might not be maturing. But yeah, maturity is just such a huge topic right now. And especially when you have all these office maturities coming due in markets that are, kind of bifurcated or have some kind of divergence. This is going to be important to keep your eye on the ball there.
Awesome. Well, so we have our upcoming report, so everybody should look out for that, right?
Absolutely.
And you mentioned that I was really intrigued by the KLOC index. Is that something that our audience can get their hands on as well?
Yeah, absolutely. They can go to our website, kcp.kbra.com, and that's something that is open to the public that can pull that down.
Awesome. So, we'll link to that when we push out this podcast. Well,
Awesome.
Steve, really appreciate your taking the time. This has been fun. And if anybody has any follow-up questions, they can hit you up, I presume.
Absolutely. I'm
Uh,
on LinkedIn and LinkedIn.
Great. Thanks to everybody for listening. You can follow the Not Podcast podcast on your favorite podcast platform, Apple Podcasts, Spotify. We're also on YouTube, and would love for you to check us out there. And also follow CompStak on social media. But thanks, everybody. Appreciate your time.
Thanks, Michael. It's fun.